I'm Owen Bigland. This is the Inside Edge video blog. Okay, happy Saturday. I know it's been a long time. By popular demand, I'm doing a Saturday blog here on the other passion in my life. There's real estate. Well, I've got a bunch. Real estate, working out, staying in shape, and the stock market, investing for retirement, RRSP, TFSA, cash accounts, and that kind of thing. So it's been a while. By popular demand, I'll give you guys one here. And I apologize. As you guys know, I'm pretty busy. I'm getting on in age these days. I'm running a real estate team. I do more and more traveling every year, as you guys probably know. I'm probably out of Vancouver now 3 months out of the year on various trips. A few are for business, seminars and things like that, conventions, and then, a lot for pleasure, taking little breaks throughout the year. On that note, I'll give you guys an update. I'm planning on being in Toronto in a couple of weeks. My first trip to Toronto in 10 years that I've actually stayed in Toronto for a while, walked around, and I'm planning on looking at some real estate, some condos that are in downtown Vancouver or Toronto. I'm also in Montreal for 3 nights as well, so I'm planning on having a look at some real estate out there, get a feel. It's been 13 years since I've been in Toronto, and then I'm out down in New York for a conference, an investing conference with a friend of mine who's a private equity guy. So I'll give you guys some feedback later this summer on my trip out there, on my feelings about Toronto real estate, Montreal real estate, and New York as well. So stay tuned for that. So investing, I always get guys, why do I should be investing for retirement? So I'll just give you guys a quick recap here, because you guys know, investing now for retirement, unlike real estate can be fairly complicated. Markets up, down, interest rates, all that other, supply, economy, all that stuff affects real estate. It affects the stock market too. But when it comes to investing for retirement through your TFSA and your RRSP, and then I tell you guys, even if you max out your TFSA or RRSP, which you should be doing, you're going to need, if you really want to build any type of robust retirement, you're going to need to have a whole lot more money outside of those two vehicles, because we're restricted. We're capped on what we can put into registered accounts. You want to be maxing both those out. As you guys know, my steps: buy your principal residence first. That's bar none. First step. After that, max out your TFSA and RRSP and get a head start on what we call your non-registered or cash account investments. Because you're going to need a lot, again, you're not going to need a lot more money than what you can rack into your TFSA and RRSP if you really want to build a good retirement. And then the third step, perhaps, would be to buy an investment unit, an investment home. But that's the final step. Take advantage of the leverage and diversify out of the stock market a little bit. But investing these days, I tell people, it is so easy now. It wasn't this easy when I started 25 years ago, because I was buying individual stocks. I've told you guys, paying massive I was ripped off left, right, and center on the brokerage fees for trades. Didn't trade a lot, but it cost me a lot. I used to buy mutual funds, manage mutual funds with an MER of 2 or 3%. Got ripped off on those. So today, investing for retirement is so simple, it hurts. And that is what I've told you guys, and what I tell you in my book, is just simply index invest and call it a day. I've told you guys, as I've gotten into my investing journey, I'm becoming more and more into ETFs and index investing as I go along. I still own a fairly large individual stock portfolio, both US equities and Canadian equities. So I own lots of Apple, Nvidia, Meta, Google, Microsoft, Johnson & Johnson, Costco, Starbucks, Eli Lilly, Visa, MasterCard, JP Morgan, Goldman Sachs, all I own individually. In Canada, I own all the Canadian banks, Enbridge, Suncor. I still own a little bit of TELUS and BCE, which hasn't been good for me, and Brookfield Asset Management. But that makes up probably now about 50% of my portfolio, maybe 40%. It used to be much higher. The other 60% of my portfolio is in a basket of low-cost ETFs through Vanguard or iShares, BlackRock. So my biggest holdings are S&P 500, the VU, the Triple Q, the NASDAQ, which is the NASDAQ 100, the VIG, the Vanguard Dividend Appreciation Fund, I also own the Schwab High Dividend Fund, SCHD, and then I own a little bit of emerging markets, some European ETFs. My average MER, or management expense ratio, probably hovers around 8 or 9 basis points, so pretty much free. As I'm getting older, I am slowly selling a lot of my individual names, or parts of my individual names, portions of them, and rolling that straight into low-cost ETFs. And the reason for that is because even though I still enjoy buying some individual names, haven't bought much lately, I'm not going to beat the indexes. And if somebody tells you they are, they're just flat out lying to you. They're not going to do it. You're not going to beat the S&P 500. I know you think you might, but you're not over long periods of time. And if you don't believe me, no problem. Don't take Bigland's word on this. Just simply buy some books on the topic. Buy some books by Jack Bogle, the founder of Vanguard, or a book by Peter Lynch. This is a book here. As you guys know, I read probably 20-25 books a year. This is a book by Charles Ellis. I think I plugged this book maybe before. Winning the Loser's Game. It's got a foreword by Jack Bogle on it. I'm getting ready to meet a client for coffee here after I wrap this up. And I read this book for a second time here this summer. And what I do a lot of times, I have a library of books that I've read. Some of them I've read many times over. But after I've read them a couple of times, usually I'll just give them away at a coffee meeting or something. So I'm going to give this book away. But it's a fantastic read. It's going to tell you what I'm telling you. Just buy the S&P 500, buy the Triple Q, buy the NASDAQ, buy the TSX 100. Just index the basket of stocks and call it a day. Reinvest the dividends and just sit back and relax. You don't have to do anything. You don't have to read any earnings statements or keep all that close of a tab. Some companies are going to pull their weight in those ETFs. Others are going to lag behind for a few years. But you guys, I've told you the dirty secret about active investing, and that is that 90% of the active managers out there, and we're talking a lot of the elite pros that are running private equity and hedge funds, smart people, 85 to 90% of them lag the S&P 500 every year. The 10 or 15% that do manage to eke out, by luck most of the time, by luck, eke out a little bit better return, cannot do it consistently, guys. They can't do it year after year after year. It's like chasing a carrot on a stick. It's not going to happen. Anyone that tells you anything else is lying to you. Don't fall for this. It's funny. I was at my club a couple weeks ago, and this is so common when I'm traveling. We'll strike up a conversation at the pool or at the gym with some guy, and inevitably, what do you do for work? I'm in real estate, and you invest. Yeah, I'm an investor in both real estate and stocks, and we'll kind of trade ideas and things like that. I was talking to a friend of mine at the club in the sauna, and we're chit-chatting about investing, and he's kind of new. He's a younger guy. He's in his mid-30s. And looking to start investing. He's putting some money away into the indexes and that kind of thing, which is great. But another guy sat down and he was overhearing me telling him, kind of preaching to them, that just to buy the indexes, buy the S&P 500, buy a basket of low-cost ETFs. Unless you really, really want to do the research and you've got a real interest in it, okay, buy a few individual names. But make sure they're the best of the best. Buy and hold strategy. But I get this so much. This one guy, he chimed in, nice guy, but basically saying, oh, I don't know about that I have some ETFs as well, but I trade Tesla and I trade Nvidia, and started talking about he's doing call options and things like this, and immediately my eyes rolled back. Now, I didn't say anything. I'm saying, well, it's just not for me. But later I told my friend, I said, with what this guy was saying, that he, buys Tesla at the low, sells it at the high, and then just keeps rinse and repeating on Tesla and Nvidia. And then the calls and puts that he was doing, I have no idea what that was all about. It sounded complicated. I told him, this guy, if what he is saying is true, that he's able to trade in and out of Tesla like that, then we should see him on the cover of Fortune magazine or Forbes or the Wall Street Journal as one of the greatest investors to ever live. That's the way he described himself. And I don't think he even realizes that. If he really thinks that he's able to get in and out of those names consistently and turn a profit, that would make him one of the greatest investors of all time. Again, I tell you guys, 85 to 90% of the pros that are probably in a completely different league than this guy, I don't think this guy was a professional money manager, they can't beat the index consistently. So I'm not sure how he can. And getting into calls and puts and margin and all that other stuff, very dangerous. Do not do it. So keep it super simple. Investing now is so easy. It really is. I wish I had this stuff when I started 30 years ago. I probably have at least a couple $1 million more in my retirement portfolio. I know I would, because again, I used to get ripped off on the trades. I used to pay $125 to buy 10 shares of Pepsi, which was obscene. I had a bunch of money in like Trimark and Mackenzie mutual funds that I was paying a 2.5. I think one of them I had a 3% MER. 3% doesn't sound like much, guys, but do the math on it. It's the compounding, the eighth wonder of the world. 3% MER over 20 years will probably cut your portfolio in half. I know it sounds impossible. I always tell you guys to go on to YouTube, watch that video by PBS called The Retirement Gamble. It won a whole bunch of awards, came out about 12 or 13 years ago. Interviews the late great Jack Bogle is in there, and it'll show you what fees can do to your portfolio. Just a 1 or 2% drag on your portfolio can wipe out hundreds of thousands of dollars. And then you add to that the fact, not only is this fund underperforming the S&P 500, but the kick in the head is we're going to charge you 1, 2, or 3% for the privilege of underperforming the indexes. So just index invest. That's all you guys need to do. Most of my stuff is through iShares by BlackRock and through Vanguard. And again, as I move into my 60s here, I am slowly trimming down a lot of my individual holdings and just rolling that money straight into a basket of low-cost ETFs. And again, that is the way I would suggest you guys do it. You will guarantee the best possible returns that way. You're not going to, outguess the market here, buying and selling and trading and paying the commissions and everything else. It's a mug's game. And again, I always tell you guys the final thing here is, and if you've read my book, Along for the Ride, I highly suggest you guys, all you've got to do is put in 100 hours. I've kind of bumped that up a little bit now to maybe 150. 150 hours, start with a book like mine. You could read Charles Ellis, Winning the Loser's Game, pick up anything by Jack Bogle or Warren Buffett. I tell you guys, I buy these books used on Amazon, cheap. I think I paid $7 for this book. I think I've bought a couple copies of this book. Whenever I see it used cheap, I'll buy it. Because I've given it away to a few people. So, but put in 100, 150 hours. So for most Canadians, that's probably, I don't know, a month of TV watching. Cut your TV down by half for the next 2 months and you could put in that 100 hours. Just learning about index investing. CanadianCouchPotato.com is a fantastic resource for index investing for Canadians. Spend 5, 6, 10, 15 hours on that. Go into the tax. I know taxes suck and pretty dry, but spend a couple hours in Canadian Couch Potato in their tax section there, just on how the various baskets are taxed. Your TFSA, your RRSP, and your cash account, and how dividends are taxed. So basic stuff. Take you 2 or 3 hours to learn that. So you've got to put that 100 hours in. It can't be spoon-fed to you. Start with some books. Start with Canadian Couch Potato. Get that 100 hours, and then you are set for life. Now you don't need to rely on a overpriced money manager to run your money. You can do it yourself for pennies on the dollar, and you will outperform 80, 85, 90% of the professional money managers out there every year, and you'll beat 100% of them. I should throw that out. You will beat 100% of them over 10, 15, 20-year periods. Because remember, these guys, some of them will get lucky for a year or two, but they can't continue that on. There's only a few elite people like a Warren Buffett or a Peter Lynch that you do not have access to. They're not going to manage your money, that have consistently beat the S&P 500. They are a ultra rare breed. You're not going to have access to them. So don't even try. So keep it simple, index invest, Thank me later. There'll be good years in there, bad years. Always just, as those dividends come in every quarter, keep a little bit of money in cash, wait for pullbacks if you want. I don't wait all that long. I like to have my money working for me pretty much all the time. I'll let my cash reserve build up a little bit here and there if the markets are at all-time highs. But there's usually something you can put your money into to make and start collecting those dividends or whatever else. I'm Owen Bigland. As always, thanks for watching. Have a good weekend. I'll see you next week.